This year alone, the world's biggest tech companies are on track to pour roughly $725 billion into artificial intelligence infrastructure. This chart puts that number into perspective. If you spent $1 million every single day, starting from the day Jesus was born, all the way through the Roman Empire, the Middle Ages, both world wars, and up to today, you still wouldn't hit what big tech is projected to spend on AI in this year. This massive influx of cash is actually moving the needle. Harvard economist Jason Furman found that in early 2024, investment in information processing equipment and software made up only about 4% of GDP. Yet that specific category accounted for roughly 92% of all U.S. economic growth. If you pull the AI build-out out of the equation, the United States economy grew at about 0.1%. The financial stability of the entire country is quietly hanging on this single massive bet. Most people try to evaluate a tech boom by looking at demand, user growth, adoption rates, and revenue. But demand can be faked. It's a story that changes depending on who's trying to sell you the shares. Instead of waiting for customers, companies today can manufacture the appearance of demand using their own capital. This diagram tracks how money moves through the industry. NVIDIA funds OpenAI. OpenAI takes that money and pays Oracle for cloud services. Oracle takes that revenue and uses it to buy more NVIDIA chips. Every time that same dollar changes hands, it gets recorded as brand new revenue. The most successful investors in history tend to ignore those noisy demand narratives. Billionaire George Soros noted that market bubbles usually have a solid basis in reality, but that reality gets distorted by a misconception. To find the truth, you have to follow the supply side. Demand is a story, but supply takes real upfront capital. It's the quiet mechanics of how that capital flows that actually dictates the financial reality of the entire market. This pattern is mapped out in a framework called the capital cycle theory. It starts with a flood. Back in the 1830s, the arrival of new railway technology triggered a massive rush of investment. Capital poured in from everyone: bankers, shopkeepers, and clergymen. Companies stopped building the rail lines the country actually needed and started building whatever drove their share price up. They duplicated routes and ran lines out to tiny villages that would never fill a single train. Once the actual revenue proved to be a fraction of what was promised, the returns collapsed. The exact same cycle repeated with fiber optic cables in the late 1990s, following a rewrite of U.S. telecom laws. Carriers buried over 80 million miles of fiber across the country and under the oceans. Equipment makers like Lucent Technologies and Nortel propped up the boom by lending their own customers the money to buy their gear, booking those finance sales as revenue to validate the growth story. When reality finally caught up, about 85% of that fiber sat in the ground unused. Bandwidth prices fell 90%. Corning, one of the world's largest fiber makers, watched its stock price fall from over $100 a share to about $1. Regardless of the technology, the mathematical reality is the same. Whenever capital floods into a sector to chase high returns, the resulting wave of competition creates an oversupply that inevitably destroys profit margins for everyone involved. That crash leads to the final step of the cycle, the inheritance. As builders go bankrupt, the assets they paid for are left behind to be scooped up for pennies on the dollar. This creates a paradox. The pioneers who build the future are almost never the ones who profit from it. They take the hits, the risk, and the losses to clear the path. In the mid-90s, pioneers like Alta Vista and Excite spent millions building the first web crawlers and teaching the world how to search the internet. They burned their cash chasing banner ads to stay alive, letting their search products decay. Google walked in after the dust settled and simply took the prize. You saw it again in rideshare. A company called Sidecar spent its existence fighting the legal and regulatory battles that made the business model possible. While Sidecar bled cash in court, Uber and Lyft copied the model, raised billions, and captured the market on the foundation their failed predecessor had built. The ironclad rule of tech bubbles is that the pioneers take the arrows of upfront risk, while the settlers quietly inherit the land. If you apply this framework to the current AI build-out, the signals are clear. We are currently crossing the threshold from the boom phase into the collapse. 2 years ago, OpenAI operated essentially without competition. Today, Google, Anthropic, Meta, and xAI have all flooded the space with similar models. Leaked financials reveal OpenAI is projected to lose $38.5 billion in 2025, nearly 8 times their prior loss. Sales and marketing spend jumped 400%, hitting $5.7 billion. They funnel 44% of revenue into marketing, just to keep people using the product. These extreme retention costs are the proof that returns are actively compressing. Supply has caught up to the hype, exactly as it did for railways and fiber optics. You can see the fragility of these valuations and how the market reacts to even tiny setbacks. Take the chipmaker Broadcom. Recently, Broadcom beat earnings expectations, but guided its future AI sales a few hundred million light. Following that news, $300 billion of the company's market value vanished in a single session. Erasing $300 billion over a fractional guidance miss is the sign of a market priced for absolute perfection. In this environment, the slightest flaw triggers catastrophic damage. But the eventual collapse of the AI bubble isn't the end. Once the dust settles and the capital flees, the infrastructure will still be there. The current tech pioneers will likely be destroyed by the very supply they created, but the massive, cheap computing power they leave behind will ultimately empower a new generation of settlers to actually change the world.